Hello and welcome back to our quarterly perspective series for Q3 2024. This is Ryan Mahoney at Cypress Asset Management. Today we will be looking at Q3 equity and fixed income performance along the framework of absolute returns, relative returns, as well as future expectations for market performance. We will then go on to discuss recent interest rate movements as well as inflation expectations. And last, we will examine how different asset classes have contributed to an overall portfolio return. We hope, as always, that you enjoy today's presentation. Now let's dive in. We begin our discussion, as always, with a high-level look at a collection of major asset classes. As we look from the illustration here, U.S. and emerging market stocks were up during Q3, contributing to the positive trend from the previous quarter. Developed international stocks were also up slightly during the third quarter, reversing the negative trend that we had seen previously. Returns for U.S. and global ex-U.S. bonds were also up for the quarter. Now let me draw your attention to the upper right-hand portion of the graphic here. The U.S. dollar was down 4.8% for the quarter and down 5.1% over the last 12 months. All right, let's look a little deeper at... now let's look a little deeper at what was driving the returns of stocks and bonds this quarter. We're going to start by taking a look at how global equities performed for the quarter, and we will isolate the performance between U.S. and developed international stocks. The two charts show the performance of different investment styles here between the U.S. and international stocks. We have the bright blue bar representing the performance of different investment styles, and the dark blue bars representing the total market performance for the region. U.S. returns are measured with the Russell indices, and international market returns are measured with the MSCI World ex-U.S. Index Series, which represents global developed market performance excluding the United States. Okay, as we can see from the dark blue line on the chart on the left, the U.S. market was up 6.2% in the third quarter, compared to up 8.1% for the developed international markets from the chart on the right. Small growth, neutral, and value stocks, as well as large value stocks, on average outperformed the market in the United States. Small value stocks led the pack domestically, which is a new trend compared to last quarter on a relative basis. Internationally, small growth, neutral, and value stocks, as well as large value stocks, tended to outperform the market, with international small value stocks posting the best performance for the quarter among international developed regions. No matter the recent trends, it is always important to remember that we should not be making longer-term projections based on these short-term trends and short-term performance. Okay, now we take a longer view to see how different investment styles have performed for standard periods ending September 30th, 2024. Looking at annualized returns in the U.S., we can see that markets have shown resilience, especially over the trailing one-year period when faced with considerable headwinds, including the continued conflict for war across the globe, uncertainty surrounding the future path of both interest rates and inflation, and, of course, paired that with what the Fed is projecting. And lastly, the dysfunction, which seems to be a constant at this point, but the growing dysfunction on Capitol Hill. All of this combined, the market was unfazed. We have U.S. markets returning 35.2% over the last year and have been nearing or exceeding 12% per year during longer time horizons. That is exceptional. Large growth stocks have the best performance for the trailing one-year period. That's really no surprise to anybody who has been following these perspective videos. They've gained 42.2% for the trailing one-year period, which beat the U.S. market by 7%. We can also see that small and value stocks have generally been out of favor during these same time periods. Consequently, we expect that portfolios that have a small value tilt, such as those that we typically design for clients, will have underperformed portfolios rather that are market cap weighted or tilted to large growth stocks at these longer investment horizons. Of course, keep in mind that the very long-term evidence demonstrates that on average, small stocks outperform large stocks and value stocks outperform growth stocks, but size and value factors can still go through extended periods of time, of underperformance, as we are witnessing and experiencing now. Okay, turning to international markets, we see that large cap growth stocks have led the pack over the 1 year period. At the longer time horizons, we see varying performance across different investment styles, with value stocks, large cap stocks, as well as growth stocks, each posting leading performance over the previous 3, 5, and 10-year periods, respectively. Pertaining to the prior slides, we see that international markets have underperformed the U.S. market by 10.4% during the trailing 12 months, as well as at longer time horizons, with the 3, 5, and 10-year performance trailing by 5.5%, 7.2%, and 7.1%, respectively. It's also worth noting that the U.S. total stock market has had an exceptional 10-year run, with the bulk of that run being driven by richening valuations and strong corporate real earnings growth. Okay, thus far we have discussed quarterly performance on a relative and absolute basis. Now we are going to change direction and take a look at current stock market valuations and how they relate to future expectations of market performance. The charts on this slide show how expensive stocks are by measuring the price to earnings ratio, or P to E ratio, a very common metric used to value equities. The higher that ratio is, the more expensive the asset class is overall. Thought of in another way, these values depict how expensive $1 of earnings is. For example, as we can see in the chart on the top left, the average dollar of earnings for the U.S. total stock market costs roughly $26.10. Internationally, we can see in the chart on the right that earnings are much cheaper, at just over $16.60 per dollar of earnings on average. The values represented here use historical fund and ETF data to establish the price ratios, and the average P/E ratio is reflected by the dotted line on the chart. These averages start in the first quarter of 2004 for U.S. metrics and in the fourth quarter of 2006 for international stocks. Now, noting the strong market performance during the last 12 months, we see both broad U.S. and international markets are now trading close to or above their recent historical averages. And we can also see that small value stocks in global developed markets appear cheaper relative to their recent historical averages. All else equal, we would always like to pay less for a dollar of earnings. These valuation ratios aid in setting expectations about the future. Low valuations today imply higher future returns and vice versa. The recent strength of broader U.S. market performance means that it is reasonable to expect lower returns than in the past, when valuations were below their long-term historical averages. The opposite is, of course, true for international markets and small value stocks globally. So it's reasonable to expect higher returns than in the past when valuations were above their long-term historical averages. Now, we'll emphasize that this is a long-term relationship, and that short-term outcomes will likely be dominated by unexpected market forces. Okay, here we have the same analysis, but isolating U.S. equities so that we can see how valuations compare across different styles. Recalling the annualized performance slides, we know that large growth has had an exceptional 10-year run, and we can see that the growth in prices has exceeded the growth in earnings as the P/E ratio has climbed to 35.7 to close the quarter, which is above its average since 2004. Small value, on the other hand, has a P/E ratio of 13.9 and remains under its average since 2004. So it's very much a tale of two asset classes here. Although many investors may be interested or tempted to chase these returns of these large growth companies, we would point to these valuation charts here as one reason to stay the course in a diversified portfolio tilted towards small and relatively inexpensive companies. Okay, next we'll take a look at fixed income performance, the shape of the current yield curve, as well as how the market is currently pricing in inflation. All right, the chart here the charts on the screen show the average performance of different bond maturities and the segments of the fixed income market that we commonly track. Of course, we prefer investing in bonds that are shorter maturity and higher quality compared to the broader market. In the chart on the left-hand side, we see that bonds of all maturity ranges had positive performance, but markets favored longer maturities relative to immediate to shorter maturities, with the 10 to 20-year segment posting the largest gain. This is, of course, because of the Fed cutting rates. The chart on the right shows the performance of different intermediate maturity credit quality bonds. We see that there was positive performance across the different credit qualities listed for the quarter, with investors favoring corporate and treasury debt relative to other credit segments. Next, we'll look at the Treasury yield curve and what it means for returns going forward. Here we'll plot the yield curve to show the current yields for Treasury bond investments at different maturities. All right, the light blue line represents current rates. The dark blue line represents rates from the end of the previous quarter, and the gold line represents rates from 1 year ago. As we see from the yield curve, rates decreased for all maturities during the quarter. As stated previously, this complemented longer-dated maturity debt. All right, looking forward, long-term expected returns for fixed income look to continue to decline due to the Fed's shift to cutting rates. However, for fixed income investors, this is a positive, as a lower rate environment going forward serves to increase bond prices in the short term, resulting in capital gains. The yield curve is no longer inverted as it had been since the start of the third quarter in 2022. As stated in previous commentaries, when this happens, particularly between 2-year and 10-year periods on the curve, or points in the curve rather, this phenomena is widely considered to be one of the precursors, but not necessarily any guarantee to an impending recession. So it remains to be seen whether the prolonged yield curve inversion will prove ultimately to be an indicator of a recession. Finally, we plot the market's forecast of inflation by taking the difference in yields between U.S. Treasury bonds and TIPS at different maturity levels. Just like the previous chart, the bright blue line represents current inflation expectations. The dark blue line represents inflation expectations from the end of the previous quarter, and the gold line represents inflation expectations from 1 year ago. Current market estimates for future inflation have been showing inflation beginning to cool as compared to the prior quarter and this time last year. Inflation readings have continued to moderate. Recent favorable trends appear to convince the Federal Reserve that inflation may, in fact, be under control, as its 2% inflation objective is starting to show evidence that inflation indeed is able to stay at that target in a sustainable manner. To that end, the panel is recalibrating monetary policy and implemented a 0.5%, 50 basis points, a 50 basis point rate cut at their meeting this past September, representing the first rate change in a year and the first rate cut in more than 4 years. The Fed has shifted its focus to the U.S. labor market and to maintaining full employment, with suggested further rate cuts forthcoming in November and at December meetings. Of course, that's forthcoming expected cuts, but they have yet to occur. All right, as these expectations continue to evolve, it's important to remember that these levels of inflation are baked into prices today. The markets are pricing an average inflation rate of approximately 2.1% for the year for the next 5 years, and the market collectively expects inflation to similarly outpace the Fed's 2% target over the next 30 years. Not only are these expectations built into bond prices, but they're also baked into, yes, equity prices as well. Thus, making a bet on lower inflation would mean that we expect inflation to fall short of the current forecasts. Next, let's take a look at how some major asset classes contributed to a 60-40 mix this quarter. That's 60% equity, 40% fixed income mix, and how that index mix behaved during recent history. All right, here we look at the absolute impact of different asset class returns on the quarterly return of a sample 60% stock, 40% bond index mix. With stock and bond markets moving upwards this quarter, we can see that this equity and fixed income asset class both contributed to the overall increase of the mix. U.S. large cap stocks were the largest contributor for the quarter, while emerging markets had the smallest contribution to overall return. Diversifying stocks across geographies, as well as across investment styles, and as well to allocating towards bonds helped to avoid undue portfolio concentration risk while allowing for ample growth this quarter. This resulted in the 60-40 index mix achieving a return of 5.8%. Compare that to the U.S. total market return of 6.2%. So pretty close there. The portfolio was able to achieve a smoother outcome, however, with less overall risk given its diversification across different asset classes. Next, we see a collection of major asset class calendar year returns displayed on a quilt-like chart. Looking at year-to-date returns in the rightmost column, we can see that all asset classes posted positive performance. The S&P 500, a popular headline index primarily tracking U.S. large growth companies, gaining the most value at 22.1%. We can also see that the performance of each individual asset class tile shows no predictable return or relative ranking from one year to the next. A diversified index mix such as the 60% stock, 40% bond mix, as shown in the white tile, tends to stay away from the extreme returns, both positive and negative, on an annual basis, as well as over time, while dampening the volatility of those returns. This is an example of the potential benefits, not guaranteed, but potential benefits of a well-diversified portfolio. It also helps us as investors to stay in our seats through any given quarter of market turbulence and not to take away from the ability to prosper from the many quarters yet to come. Okay, and with that, we have reached our conclusion of today's presentation. Thank you as always for joining us, and we will see you next quarter.